Everything we thought we knew about the labor market apparently is a lie. According to the U.S. Labor Department, preliminary estimates of non-farm payrolls benchmark revision would cut March 2024 levels of employment by 818,000 jobs, or 0.5%. This is the biggest negative revision to payrolls since the global financial crisis. And according to Zero Hedge, this is his opinion, crucially it took place in an election year and was meant to pad the numbers, making the economy appear much stronger than it was. Honestly, it's just shocking how bad the government is at collecting data. Like, you and I could do a better job. Tom Lee shares this post from David Rosenberg to his X account that says the fact that the Fed hiked the funds rate 75 basis points in the last leg of the tightening cycle when it mistakenly believed that non-farm payrolls were 818,000 stronger from March 2023 through March of 2024, as per the QCEW revision should be incentive enough for Powell and crew to start getting the ball rolling quickly. A 50 beeper on September 18th shouldn't be ruled out. Capital Economics says those payroll revisions were roughly in line with what we had expected. Non-farm payroll growth from April of 2023 through March of 2024 looks to be softer than first thought, but not worryingly so. That supports our view that when the Fed cuts interest rates, it will do so in 25 basis point steps rather than a larger 50 basis points. And if that wasn't bad enough, Kamala Harris backs Biden's 44.6% capital gains tax proposal. It also includes a 25% tax on unrealized gains, which is just mind-bending to try to even analyze what that means for your money. What? So you're going to tax capital gains? Okay, great, fine. They already do that a lot. But you're going to tax unrealized gains as well. Does that mean you get to write off unrealized losses? Does that mean more people will just go out into the markets and speculate more and buy riskier assets? Because if you lose all your money, you can just write it off and get a tax break. That could actually prompt riskier risk-taking behavior, which I'm all up for risk. And I think there's a fair dose of your risk takers out there in the markets. But if you thought we've seen a speculative frenzy before, you haven't seen anything until they start to tax unrealized capital gains. And it would likely also make a market that is less focused on buying and holding and more focused on short-term trading in nature. But to be fully transparent with you, we're probably never going to see unrealized gains actually be taxed unless it's like very wealthy people. Like Elon Musk, Bill Gates, Warren Buffett, these individuals would have to worry about this a lot more than you. Bad news, the SPX didn't make it 9 consecutive daily gains. Good news, it did make 11 consecutive higher lows. You have seen this 20 times since 1954 with a positivity rate one trading month forward of 85% with a mean return of 2.37%. Which, if that holds true, that's going to put the S&P 500 well above a new all-time high. We also did get really good news today via Target earnings. Target has cut prices on 5,000 products. Now it's back with a big earnings beat, is the main headline here on Yahoo Finance. The discount retailer shredded Wall Street profit forecast on Wednesday, topping them by 39 cents a share on the back of renewed traffic to stores. Traffic increased 3%, with all 6 departments at Target contributing to the improvement. Net sales were up 2.7% year over year to $25.5 billion versus estimates of $25.48 billion. Gross profit margin came in at 28.9% versus 27% a year ago and beating estimates for 28%. Diluted EPS was up 43% year over year to $2.57 versus estimates for $2.18 and prior guidance of $1.95 to $2.35. So they killed it across the board. Guidance did come in a little bit light though. Third quarter earnings per share are projected to be $2.20 to $2.40 per share compared to estimates of $2.24. So a little bit lower on the low end and higher on the high end. Usually you go with right in the middle, so that's $2.30 per share, but some people would argue that was a little bit weaker than what we would expect to see given the beat that we just seen this last quarter. And Target's CEO really just cites more traffic heading to Target as the reason for the strength in the business, which is exactly what Wall Street wanted to hear. We wanted to hear people are going to Target. They're spending money, and not just Walmart. This is alleviating some of the fears that the consumer is just falling out of bed. And there's two things that you may have noticed today about markets. Number one is you are seeing the equal weight S&P really outpacing the market cap weighted S&P. So what this means is you're actually getting a broader market rally today. And I think a lot of that is on the back of Target's earnings. The RSP, which is the equal weight S&P, is up 0.62% today. The regular S&P is up 0.3%. Well, technically the SPY. So you are seeing a 2x outperformance of the equal weight S&P, which is good for your portfolio. Unless obviously you're in the big tech names or SPY as a large portion of your portfolio. If not, you're probably seeing your portfolio outperforming the markets by quite a margin. You can also see the Russell 2000 is up almost 1% today, and that's almost 3x outperforming the S&P. The second thing you'll notice about markets today is even though the Russell's up 1%, the Nasdaq's up 0.5%, S&P's up 1/3, the Dow is pretty much break even. It's a good day for markets. Generally speaking, the VIX is up almost 5% today. And if you know anything about the VIX, then you know the VIX goes higher when more puts are being bought on our markets. So actually, the options today are not nearly as good, or option activity is not nearly as good in the S&P as what you would expect to see on a day where the S&P is up 1/3 of 1%. In fact, there's more puts being bought than calls by a pretty large margin. And that's because there is a good deal of nervousness heading into tomorrow, because tomorrow is the day in which we really get the most data for this week. 8:30 in the morning tomorrow, you will get the Chicago Fed National Activity Index, expecting that at negative 0.2%. That's worse than last month. Initial jobless claims are expected to be 230,000, up from 227,000 last week. So that's not great, but 230 would still be a just fine number. As long as we're not like 240 plus, I think Wall Street will like it. Continuing jobless claims are expected to step downwards. Well, not as much. Actually, you're expecting this to go up 6,000. But this is a downward estimate from the last estimate that we had. Okay, so estimates are still, getting placed for this data tomorrow, but you are expecting only a little bit of a stair step up for continuing jobless claims. You will get S&P Global Composite PMI, S&P Global Manufacturing PMI, and S&P Global Services PMI. Across the board, you're expecting slight weakening to these numbers, but nothing that's really dramatic in nature. If we get, numbers that come in really low, that's not good. If we get numbers that come in really high, that's good. Could be inflationary. We'll have to see what the actual, services PMIs say, manufacturing, composite PMIs. But on the headline, higher numbers are going to be good for markets. You will also get existing home sales for July and existing home sales month over month that will come out at 10 o'clock in the morning, as well as that the Kansas Fed Composite Index and the Kansas Fed Manufacturing Index expected to come in at -10 for both of these. So still really bad numbers, but not as bad as last month. So when the markets are this sensitive to economic data, to indications of strength or weakening in the labor market, specifically around initial jobless claims, it's not a big surprise that you are seeing more puts being bought on the S&P, given we've almost rallied 10% from those lows that you were just at like 2 weeks ago. So with this aggressive of a rally, can you blame anyone for buying a put or two? I definitely can't. With that said, today in after hours, we will get earnings from Snowflake, Zoom, Wolfspeed, Synopsys, Agilent Technologies, Urban Outfitters, Nordson, Carlisle, and a couple other companies. Tomorrow morning, Baidu, Peloton, Advanced Auto Parts, Canadian Solar, BJ's, and Weibo, as well as TD Bank, will be reporting earnings. And then tomorrow in after hours, you have Kava, Workday, Bill.com, Intuit, Ross, and Red Robin that report. And none of these earnings will be super impactful for the broader markets, but certain earnings, like maybe Snowflake, could affect some of your AI, potentially software companies. And I do think something like a Kava can affect restaurants, right? There can be sympathy reactions in these sectors where these companies are reporting earnings. Lance Robert on X says global liquidity is back on the rise, which should stabilize global economies and reduce recession risks further. And if the long-term cycle is correct, liquidity should increase a lot more from now throughout 2026. Liz Ann Saunders on X says global freight container rates are rolling over again. They're still much more elevated for routes including Shanghai. As Nick Timmerhouse writes on X, US mortgage rates ticked down last week to 6.5%, but this isn't doing anything for mortgage purchase demand, which slowed again last week. Rates are at levels last seen in May of 2023, but purchase apps are down 20% below where they were then. Dan Ives writes, we believe this will be another mic drop moment for tech in regards to Nvidia earnings that come out next week. We did get a Zweig breadth thrust that has historically been a strong indicator of S&P 500 performance over the next 6 to 12 months, averaging a 23.5% increase in value 1 year later since 1945. And this just occurred. So there's a really good chance that markets are higher 1 year from now. Neil Hennessy says investors should look beyond Mag 7 to find value. Take a listen to this clip. Because like we're seeing today, the equal weight S&P is outperforming the headline S&P, and the equal weight S&P is outperforming your Mag 6 or Mag 7 if you want to group Tesla in that. And I think this is something that will continue, although I think Tesla will outperform your Super 6 stocks as well.
Retail, our next guest sees some volatility, but he's got 3 dividend-paying names he thinks can weather the storm. Let's turn now to Hennessy Fund's chief market strategist, Neil Hennessy. Neil, welcome. And where's your mind at as we kind of count down the 80, 70 days till the election? And a couple of weeks ago, Amazon and everyone was telling us election uncertainty was an overhang on consumer spending. And today it feels like the mood is totally the opposite.
Well, you got to sort of look at everybody for the last couple of years, economists, analysts, everybody. I'm just an economic realist, Kelly, but essentially they're predicting a recession. You can't have a recession with high unemployment, without high unemployment. They're going to cut the rates. Everybody's just out there trying to guess what's going to happen. And then you look at the numbers today on the employment side. We were still averaging 175,000 new jobs a month. That's good. There's still more job openings today than there are people to fill it. So looking forward, I don't let the political landscape push me one way or another. Actually, I try and turn it off and just look at value and where can you invest the shareholders' money so that they can make a profit.
Well, and understood. I mean, and I think most people would on some level agree with you, but they go, okay, if I have to consider it, I'll consider. I mean, even things like the proposed capital gains taxes, those issues that would be kind of more squarely in the investment wheelhouse. Do you pay attention to those, or do you think that's just a lot of talk and not much is going to actually happen?
There's not a lot I can do about it, nor anybody else, until it's actually enacted. If you look at one of the roughest spells that businesses had was under President Obama's legacy, where more rules and regulations came in, Kelly, than ever before, but we weathered the storm. New taxes, tariffs, this, that. Until we actually see it, there's no reason to go gamble when you can go buy value. As I told you before, the Magnificent Seven, that game's over. People are now shifting to value. And after you see what the Feds are going to do, and everybody's predicting maybe 100 basis points, maybe 6 cuts by the end of the year, come on. The best I think we're going to get, Kelly, is a sympathy cut, 25 basis points, and let it play out because the economy isn't as bad as the headlines are telling you.
Is the Magnificent Seven, let me try to pull up our CNBC index, is it really over, Neil? Because if anything, that's been leading the rebound since that recent sell-off, whereas the Russell keeps underperforming.
Yeah, sort of look at it. Look at the Russell mid-cap. It's up under 10% this year. The Dow Jones is up less than 10%. You're looking at the Magnificent Seven, 8 stocks, okay, that make up 33% of the S&P, 43% of the NASDAQ 100. Come on, Kelly. Once you get overweighted that way, you know the game's over.
I know, but
euphoria.
But listen, I'm on board with you intellectually. I'm just watching the market action.
Well, short term, I don't know where the market's going to go or these are going to go short term. I'm trying to look long term and say, are you going to be able to play tomorrow or not? Maybe you are, maybe you aren't. You can look at the carry trade 3 weeks ago. Everybody thought that was the easiest trade in the world. And then it comes to the point of unraveling, and everybody's going, oh, Lord, what's going on? So I'm just looking at the mid-cap sector is where people should be putting their money, because if you look at it, so far this year, $120 billion have come out of stock equity mutual funds, and $10 billion has got in the money market funds. If rates come down, that money's going to come out of money market funds, and where are going to go? I would assume, and I would think logically, it will go into the mid-cap sector.
Well, I know that you're hoping so, at the very least. You do have names from a kind of across the economy. You like Oshkosh, the industrial. I think that's an industrial. You've got Group 1. You've got Guess. I mean, you've got a retailer in there, but my guess is that I assume that's less about, kind of what's going on with consumers more broadly and more about the valuation for you.
Well, I think, it's all about the valuation. You look at all 3 of those stocks, they all have a PE of half of what the market is at 9. Their price to sales ratios are 0.3, 0.4, so you're buying them at 30, 40 cents on the dollar. They pay dividends. They're making a ton of money. And the one thing we've talked about numerous times, Kelly, when you look at the mid-cap sector, they are big enough to weather an economic tsunami, a soft landing, hard landing, whatever you want to call it. They're also big enough to be bought by somebody to be accretive to somebody else. They're also big enough to make an acquisition to be accretive. So why go risk and gamble on 7 stocks when there's so many other good companies making a ton of money and cash flowing than just 7 companies?
And I think he supports what I've said this entire time. You don't want to be in just big tech. You really want to broaden out those portfolios into value, into high-paying dividend stocks, into small caps, mid caps. Basically, I like everything else besides big tech. And that's crazy, because it's almost like the opposite. The markets only love big tech and hate everything else. But after all, it usually pays to be a contrarian. If we take a look at the CNN Fear and Greed Index, today it's sitting at 50, which is exactly neutral. Yesterday's market was fear at 44. And the percent of stocks today trading above their 50-day moving average is sitting at 60%. So that's not a super great number. That's not a bad number either. That's a number in which you could definitely continue to see some broad-based participation, a broadening out of our markets, if you will. Here today, about 3% of all stocks are breaking above their 50-day moving average. So with that said, let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.